Welcome back to the deep dive. I hope you've had your coffee because the numbers we are looking at this morning they're the kind that make you want to refresh your browser a few times just to be sure.
hmm
It is Wednesday, January 28th, 2026, and spot gold is currently trading at $4,601.79 per ounce.
It's a number that definitely demands attention.
It demands something, that's for sure. I mean, we watched it climb all through 2025.
A 67% gain.
Right, the best year since 1979. But crossing that $4,600 mark, it feels psychologically different.
It does.
It feels like the market is screaming something at us.
Hmm.
But we aren't here to just gawk at the ticker. We have Dr. Fareed Novin's latest analysis, and he suggests this isn't just a bubble or, a fear trade.
No, Novin is arguing something much, much more fundamental. He believes gold is evolving.
Evolved.
For the last 50 years, gold was the safe haven, the thing you bought when you were nervous. Novin's thesis is that it's transitioning into high-powered money.
High-powered money. That sounds like a marketing term, but in economics, that usually means the monetary base, right? The foundation for everything else.
That's the entire crux of it. Novin argues we are witnessing a, quote, vaporization of trust in the U.S. dollar and in sovereign debt. This price explosion, it's not about jewelry demand. It's about central banks realizing they need a new foundation.
Okay, but let's push back on that for a second. People have been predicting the death of the dollar since the 70s.
Sure.
Every time there's a recession, the gold bugs come out and say fiat currency is ending.
Hmm.
So why is this analysis different? Why isn't this just another cycle?
Because of something he calls the reserve asset inversion.
Okay, that sounds pretty technical. Break that down for us.
It's a measurable shifting of the tectonic plates. For the first time, really, in the modern financial era, the value of global gold reserves sitting in central bank vaults has surpassed the value of their U.S. Treasury holdings.
Wait, so you're saying literally the world's central banks now hold more wealth in physical gold bars than they do in U.S. government bonds?
The lines of the chart have crossed, yes.
Yeah.
And that matters because it completely flips the script on what liquidity is. Treasuries were always the superior asset. They were liquid. They paid interest. Gold was just heavy.
And it paid nothing. We all know the knock on gold. It has zero yield. Usually when real yields are high, like they were for parts of 2025, gold should get crushed.
It should.
The opportunity cost of holding it is just too high. You're leaving free money on the table.
But that historical correlation is dead. That's what made 2025 so strange. We had positive real yields, and yet gold went parabolic.
So the market just doesn't care about the yield anymore.
The market is effectively saying, I don't care about the 5% yield on the bond. I am worried about getting the principal back. The return of my money has become more important than the return of my money.
That's the mindset of someone who thinks the bank is about to burn down?
It is. And the data, it really backs this up. The World Gold Council survey from 2025, which Novin cites, asked central banks about their intentions. 95% said they expected to increase their gold reserves in the next 12 months.
And let me guess the number who plan to decrease.
0%.
See, that's what bothers me, a 95% consensus. In markets, when everyone is on the same side of the boat, that boat usually tips over.
Right.
Is this just a crowded trade, or is it a structural necessity?
I think it's structural.
Yeah.
And that's because of the geopolitical layer. We have to talk about sanctions.
And this non-sanctionable liquidity architecture.
It's a mouthful, I know.
Yeah.
But think about the mechanics of trade. If China wants to buy oil from Iran or Russia, and they don't want to use dollars, they need some other way to settle the trade.
They could use yuan or rubles.
They could, but those can be volatile. They need a final layer of trust. And gold is the ultimate bear asset. Remember February 2022?
The freezing of Russia's reserves.
Exactly. Yeah. When the G7 froze $300 billion of Russia's reserves, they proved that digital dollars aren't really yours. They are permissioned. They exist on a ledger that the U.S. ultimately controls.
So if you're a strategic rival to the U.S., or even just a neutral country worried about getting caught in the crossfire, holding dollars is now a liability.
It's a huge liability.
Yeah.
Physical gold sitting in a vault in Shanghai or, Brasilia cannot be turned off by a switch in Washington, D.C. It's become an active geopolitical hedge.
It's not just an investment then.
No, it's an alternative operating system for global trade.
That implies a level of coordination we haven't seen before. Let's look at the players, because the Global Gold Tour section of the source material was fascinating. We all know about China.
36 straight months of buying.
Officially, yeah. The People's Bank of China reports reserves over 2,300 tons.
And Nobin suggests the real number is likely much higher, hidden in other state agencies. They're building a petroleum backstop, essentially trying to link their currency to gold so oil exporters will accept it.
But the one that really caught my eye was Poland.
Ah, yes. The National Bank of Poland, the most aggressive sovereign buyer in the world right now.
See, this is what I mean about the narrative shifting. Poland isn't some anti-Western rival. They are a NATO member, a staunch U.S. ally. Why are they frantically buying gold?
It's geography and history. They are a frontline state, bordering Belarus and Kaliningrad. Their governor, Adam Glapiewski, he views gold as a non-confiscatable sovereignty reserve. Meaning, if the worst happens, a war, a cyber attack that wipes out digital banking, gold is the one thing that still works. It's physical.
The source material mentions this incredible story about their repatriation efforts back in 2019. I want to dwell on this because it just paints such a vivid picture. This wasn't a wire transfer.
Oh no, this is a physical boots-on-the-ground operation. You have to picture the scene. It was a series of operations in the dead of night.
Wow.
The NBP chartered 8 separate cargo planes. They hired elite security contractors G4S to move 100 tons of gold bars from the Bank of England in London all the way to Warsaw.
Like a reverse heist movie.
Basically, yeah. Police escorts, helicopters overhead, the whole 9 yards. They flew it back and drove it to the central bank vaults near the Vistula River.
Why, though? Why all the drama?
Glapiewski wanted the Polish people to know that the wealth of the nation was physically there, on Polish soil. It's a powerful statement.
That level of logistical paranoia, spending millions just to move the metal closer to home, it tells you everything. They don't trust the custodian. Even the Bank of England wasn't safe enough for them.
Well, it's not even about trusting the British, necessarily. It's about eliminating counterparty risk entirely. If it's in your vault, you control it, period.
And it's not just governments. We have to touch on India. The source calls the Indian household sector the floor of the market.
They are the whale that never really surfaces. Indian households hold an estimated 25,000 tons of gold.
That's more than the official reserves of the U.S., Germany, and the IMF combined.
By a lot.
And despite the price being at $4,600, which makes jewelry crazy expensive, demand there hasn't collapsed.
It's shifted. Coin sales doubled in 2025.
Yeah.
Digital gold purchases tripled.
Yeah.
The Indian consumer is incredibly sophisticated when it comes to inflation. They can smell currency devaluation before the economists do.
So they're just converting rupees to gold?
As fast as they can. They're voting with their wallets.
So you have the global south, the east, even parts of Europe, all building this fortress of gold. They're all hedging against something. And that brings us to the elephant in the room. The issuer of the currency, they're all fleeing. The United States.
The defensive hegemon, as Novin calls it.
The numbers here are they're heavy. We are looking at a national debt of $38.43 trillion. But big numbers just numb people. What is the specific mechanism that's making the market panic now?
It's a concept called fiscal dominance. The issue isn't just the total debt, it's the cost of carrying it.
The interest.
The interest bill.
Yeah.
Because rates are higher now than they were in the 2010s, that bill has just exploded. The U.S. is now paying nearly $1.2 trillion a year just in net interest.
To put that in perspective, that's more than the entire defense budget.
It's more than Medicare. It is rapidly becoming the single largest line item in the budget. And here's the trap.
Okay.
The U.S. government has trillions of dollars of old debt, maturing debt that was issued when rates were, 1 or 2%. They have to pay that back by borrowing new money at 4 or 5%?
So even if Congress magically cuts spending, the bill automatically goes up.
Correct. It's refinancing cliff. And investors look at that math and they ask, how do you possibly pay for this? The only way out, historically, is to print the money.
Which causes inflation.
Which debases the dollar.
Which makes you want to buy gold. It's a perfect feedback loop.
It is a spiral. And the U.S. isn't alone in this. Europe has its own version of this drama, especially the tension between the North and the South.
The doom loop of Italian debt.
Right. Italy holds the world's third largest gold reserves, almost 2,500 tons. That's worth over $360 billion today. That is a massive asset for a country that's often seen as financially fragile.
And the Meloni government is trying to leverage that somehow.
They are clarifying that this gold belongs to the state, not the central bank. It's a way of signaling to the European Central Bank, hey, we have collateral.
This connects to that term in the notes, the TPI, the Transmission Protection Instrument.
Exactly. Think of the TPI as a giant fire hose the ECB keeps in a glass case. If investors start dumping Italian bonds and their yields spike, the ECB is supposed to break the glass and spray cash on the market to calm things down.
But the fire chief, the ECB, gets to decide if you deserve the water.
And there are always strings attached. Austerity, budget cuts. Italy wants to use its gold as its own independent water tank.
So they don't have to beg Brussels for help.
It gives them autonomy.
Yeah.
But you can imagine the Germans don't like that. The Bundesbank usually hates anything that smells like monetary financing.
They hate it.
And yet Germany is also quietly repatriating its own gold from New York and London.
So even they're worried.
They're worried about U.S. policy divergence, maybe future tariffs or trade wars. When your allies start checking their insurance policies, you know the neighborhood has gotten dangerous.
Okay, so we have a liquidity crunch, a debt spiral, and a major lack of trust. The source material outlines a potential solution that the G7 might try to pull off to stop the bleeding. The gold swap mechanism. How would that even work?
This is the break glass in case of emergency option. The problem is, governments need cash to pay debts, and they have all this gold. But they can't just sell the gold.
Right, because if the U.S. or Italy dumped 500 tons on the market, the price would crash.
It would crash the price. But worse, it would signal total desperation. It would be blood in the water. So instead of selling, they swap it.
Like a pawn shop.
In a very sophisticated way, yes. A central bank, say the Bank of Italy, would transfer legal title of some of its gold to another entity, maybe the Bank for International Settlements. In return, they get liquid cash dollars or euros.
So they get the cash they need to pay the bondholders, but they technically keep the gold on their books as an asset.
They keep the exposure to the gold price, yes.
Right.
It unlocks the value without the political suicide of selling the family silver.
It turns a sterile asset into active working capital.
Exactly.
But politically, I mean, can you imagine the headlines in the U.S.? Fed swaps Fort Knox gold to bail out bond market. The populace would tear the roof off the Capitol.
It would be absolutely explosive. Critics would call it a Wall Street bailout. The Germans would call it printing money by other means.
Yeah.
But Novin's point is that we are running out of good options.
Right.
If the choice is a sovereign default, where Italy or the U.S. actually misses a payment, or a controversial gold swap, they're going to choose the swap.
It's the least bad option on a menu of disasters. So looking forward, we are in 2026. Novin sketches out 3 scenarios for where we go by 2028. Let's debate these a little, because I'm not sure I agree with his probabilities.
Okay, let's start with the base case. Scenario A, status quo. He gives us the highest probability. The world stays split between a dollar block and a gold block. The U.S. sort of muddles through.
And gold grinds up to $6,500, maybe $7,200. That feels optimistic, or maybe complacent. It assumes nothing actually breaks. With interest payments at $1.2 trillion, can we really just muddle through for 2 more years?
Well, it assumes the Fed manages the yield curve aggressively, maybe cutting rates even if inflation is sticky, just to keep the government solvent. It's the path of slow currency debasement, not a sudden crash.
Okay. Then you have scenario B, the sovereign debt crisis.
Yeah.
The bull case for gold.
He gives that a 25% probability. A black swan event, a failed debt auction in a G7 country. Suddenly, nobody wants the debt anymore.
And gold goes to $10,000.
$8,500 to $10,000, yeah. This is effectively a system reset, a new Bretton Woods moment where gold is formally remonetized because fiat has just lost all credibility.
Honestly, looking at the polarization in the U.S. and Europe, 25% feels a little low to me. One political standoff over the debt ceiling could trigger this.
It could. Trust is fragile. Once it breaks, you can't just tape it back together.
And finally, the bear case. Scenario C, tech deflation. Can the robots save us?
This is the hope that AI drives productivity so high that GDP explodes, tax revenues surge, and inflation just collapses. The U.S. passes radical fiscal reform, fixes Social Security, balances the budget.
And gold drops back to around 3,800.
Correct.
I have to say, that one sounds like science fiction. Fixing the U.S. budget and a productivity boom at the same time.
It requires a lot of very difficult things to all go right at once, but it is the only real way out of this that doesn't involve some kind of currency crisis.
Even in that scenario, the bad one for gold, we are still talking about $3,800 an ounce. That's still historically incredibly high. It really seems like the floor has fundamentally moved up.
That's the key takeaway. The floor has moved because the system itself has changed. We are not going back to the world of 2015.
So let's wrap this up. We've covered Polish spy flights, Chinese oil trades, the whole U.S. debt spiral. What is the one thing you want the listener to really take away from this?
I think it's the concept of the referendum. The rise of gold isn't just a market fluctuation, it is a vote.
A vote of no confidence.
Yes. The central banks, the very institutions that issue our paper money, are frantically trading that paper for metal. They are telling us, through their actions, that they do not trust the long-term viability of the debt markets they're supposed to oversee.
It really creates a dissonance, doesn't it?
Right.
We walk around with dollars in our pockets, assuming they are the bedrock of value. Meanwhile, the architects of the system are buying insurance against their own product.
Watch what they do, not what they say. That's the oldest rule in finance.
That is a very sobering thought to leave you with. If the central banks are hedging against the dollar, maybe you should ask yourself why you're holding on to it so tightly. We'll be watching that $4,600 line very closely to see if it holds. Thanks for diving deep with us today.
Always a pleasure.
We'll see you next time.